is Morning Call, live from CNBC TV 18 headquarters in Mumbai.
Good morning. Welcome to Morning Call. I'm Lata Venkatesh. With me are Sonia Shenoy and Anuj Singhal. Well, our seat belts are in place, but let's hope that it's not going to be as chaotic a trading day as some of the days have been in the past, including yesterday. The handover from Wall Street still looks extremely eerie. Look at that, losses nearly 3%, any index you pick, and now all of them would have given you year-to-date losses. If you had bought them on Jan 1st, you're sitting on losses or any time thereafter. So market's not looking like a positive place if you looked at this. And the same data which was available to us yesterday when we were trading, the Chinese manufacturing data, both the official data and the Caixin data had come in lower than in previous months. So in a sense, Asia has already reacted to it. The other fear roiling those markets globally as well as in the United States is the Federal Reserve's likelihood of rate hikes in September. For that, of course, the markets will want to look at the non-farm payroll numbers. If it's above 200,000, then perhaps the fears will only increase. All these fears are very much there, but there are a couple of positives that we have to take home today. It's not just the MAT. We have, of course, discussed that to death, and that's not the reason why the markets were falling anyways in the last few months. What could be positive is that finally Dow futures are in the green, and that's pulled the Nikkei up. So is there an exhaustion of selling for now is what we have to ask ourselves. That might help us as well. And let's anyway remember that the FI selling at 600 crores was not a whole lot yesterday. But I'm still worried about the Bank Nifty. If that delivery-based selling was not an indication, now fresh onslaughts. Every time commodities fall, there is a bit of a jitter for Bank Nifty because that much more steel companies and metal companies can be bad news. The new base rate rules, which are not effective, they are draft rules. So I'm just worried about the banks, but maybe there could be an exhaustion of selling today.
We hope so. For our own market's sake, we hope so, because the SGX Nifty is also indicating that the start could be positive. I mean, the SGX Nifty itself is up about 0.5%. But you know what? This global growth scare picture is now, spooking investors quite a bit. First, it was China, so it was restricted to there. Now it's the US markets as well. The US manufacturing growth has fallen to a 2-year low. So we are in this phase, one of these phases where, the global growth scare is hitting. Crude fell 8% overnight. In yesterday's trade, and today as well crude is lower because of huge US oil inventories. So that's another thing that we need to take into cognizance.
We have to always accept that China cannot be a Chinese problem.
Of course,
if it is contributing 50% of the global incremental GDP, it can never be a Chinese problem. It would be a global problem. And now they're also selling US treasuries. So there's a bit of an impact on US yields as well. And Canada is officially into recession. Today we had Australian GDP numbers. That's like 0.2% above the previous quarter. 2% annual growth. So, I mean, how can it be a China problem?
Yes, I think at some point, that's going to be the overarching theme, a global growth scare, and that's seen in the numbers in our own markets as well. There was a big sell figure of almost 700 crores in the cash markets. There was selling of 700 crores in index futures, but there was not too much by way of selling in terms of individual stocks. Yes, there was selling seen in 250 crores in ICICI Bank, Axis Bank, and about 200 crores in SBI, Tata Motors, but a couple of these other heavyweights like L&T and Reliance saw about 300 crores of selling. So I guess even if this MAT relief is taken as a sentiment positive, I think the market has the other bigger theme on its mind, which is the global growth scare.
No, I was actually going to ask you, even the car sales numbers are not indicating that things are even as good as they seemed a couple of months back.
Oh no, in fact, if anything,
turning the corner
for
exactly.
It's worsened for companies like Maruti, for companies like TVS, where there was some domestic growth. Now there as well things have fallen. But we'll talk about that in a bit. Anuj, morning. Today it's interesting. The SGX Nifty is actually in the green. Are you getting a sense that at some point through the day we could perhaps see a rebound?
Morning, Sonia. The big question for me is, are we at an inflection point? You'll remember yesterday I told you that don't expect a large FISL number, and that's what we did. Look, let's explain what's happening in our market. Right now, yesterday's market fall was without any kind of delivery-based selling. There was, one or two stocks like Reliance or L&T which saw delivery-based selling. But apart from that, this market fell even without delivery-based selling. And look, I mean,
absence of buying.
FI has sold 670 crores. DI has actually bought 680 crore. Net institutions actually bought 7 crores, and still the market fell 200 points on the Nifty. Why did that happen? That happened because our market lacks depth. Our market, we've made our market so much FI-driven market that any kind of selling from FIIs leads to a bit of a panic factor or a big decline in the market. The DI lots are, the smarter lots. What they do is they put limit orders. Limit orders in a sense that if a stock is trading at 550, they would put in a buy order, say 530 or 535. From FI point of view, if he has to exit, he would take the market order, sell at even 530, 535. That would lead to that decline. That would mean that the DIs have bought, FIs have sold, but because the selling has taken place at a much lower than the market price, the stock falls, and that leads to that cascading impact that you see.
But Anuj, as you have been saying, that it was not a huge amount of sell. Is this an absence of buyer's market? A fear that, today you buy and you're left holding with NAV losses tomorrow, and therefore the DIs also restrict buying?
No, it's not absence of buying as well, because each dollar of FI selling is being matched by DI buying. The problem for this market is that right now everyone believes that dips are buying opportunities, especially from retail, and that's why every dip is being bought. And that is the other problem for this market. And that's my bigger fear, actually. What if this market does not reverse from this? What if this market actually has to go through a painful correction of maybe even sub 7,500, sub 7,000? Would that damage the equity cult? That's the bigger term question, of course, that we'll get an answer to over the next few days. But in the near term, there's a chance that we may have reached a bit of selling exhaustion yesterday. There's the kind of selling that you saw from FIIs and the kind of buying that you saw from DIIs. That also coincides with the fact that the market is now at the August lows, August closing lows. It's not yet made the August intraday low. The August intraday low is still another 100 points from here. So the next 100 points are crucial. If over the next 100 points the market gives you a bounce and rallies 200, 300 points, for the near term you may well have put a bit of a double bottom at around 7,800 mark. But make no mistake, this market is not rushing back to 8,500 or 8,600, because all rallies would be sold into. If the market goes to 8,000, 8,100, there would be temptation to sell. So that would be the problem for this market now. The other problem, as I said, which makes me a bit nervous, is what's happening with the F&O data. Because in the F&O data, FIs have been selling index futures. Yesterday also there was selling of about 700 crores, and they added about 60,000 shorts. The clients, which is the domestic money, that's buying all dips. Yesterday they added 17,000 index longs, and they unwound actually 23,000 index shorts. I was just looking at the last month data. Similar thing kept happening last month. They kept buying all the dips, and FIs kept shorting the market, and we saw what happened in the August series. Also, yesterday we spoke about the fact that look at the put data, the kind of build-up that we have seen at 7,200 to 7,000 puts. And look at the premium. 7,200 put yesterday traded at 64 rupees after the kind of surge we saw. It's 600 points out of money for a series which is 3 weeks old, which has 2 market holidays. It has no business trading at 64 rupees. It's trading at 64 rupees because there's a fear factor in the market, there's panic in the market, and normally these are the times when the market decides to give a trading bounce, 100, 200 point bounce. So I won't be surprised if there's a 100, 150 point bounce in the Nifty. But the key would be whether it gets sold into, because that is the big worry now, that every rally is going to be sold into.
It's a word on this larger worry you raise every day on, people are buying the dip, so is there a 7,000? Is there a 6,500 coming? I spoke to an economist in Jackson Hole during those Jackson Hole meetings, and he said, we are all children of the post-Lehman psyche. Every time there is a correction, we see a meltdown. And he was pointing to the psychology in US after the Depression, after the Great Depression. For 30 years, Americans did not buy shares because, you always thought every correction would be a depression. So perhaps even now we think that we will sell off because the retailers sold off in 2008. Maybe, it's just that we're prisoners of our psyche. Maybe shares will fall, but maybe 6,500 is just a post-Lehman scare.
All right, well, hope it's just that, a post-Lehman scare and nothing else. But here's what you'll get to see on the show this morning.